Portfolio Builder members, welcome to our November 25th trade alert. We hit a maximum profit on the SPY ETF. We'll jump into the trade alert in a minute. I've got a lot of content gathered over the weekend, including why the market's so hyped up, yet the bond market's rallying at the same time, conflicting messages. Emerging markets still kind of slacking. We'll take a look at all that and more in a minute. Quick little intro about what we do, and we'll jump into today's trade alert. Daily income trade alerts at noon Eastern. Current trade allocation is 54% equities, 38% bonds, 8% gold. Our target income is $750 a month per $75,000 invested. The SPY ETF is traded Monday, Wednesday, Friday, taking advantage of 3 option expirations per week. Emerging Markets ETF is traded on Tuesdays, again at noon Eastern. And then we trade the TLT, that's your 20-plus year Treasury Bond ETF. And then the Gold Miners also on Thursday. And again, our target return is 1% a month. Sometimes we're slightly below, sometimes we're slightly above. Our worst month to date is negative 1%. Over a 90-day period, we've never lost money. And just keep in mind, this is a very conservative retirement income strategy where we're more than happy to avoid losses than speculate and try to hit big wins. And so when the market has a lot of uncertainty in it, we'll just play it safe and protect our capital instead of being hopeful and trying to get lucky. Now, our product really stands out when the S&P 500 sells off, especially for considerable amounts of time. So if you're tired of volatility in your portfolio to generate return, I think you'll really like our risk to reward ratio, where our maximum loss is 1%, but over the past 12 months, we've delivered a 15% return. Over the same period, the S&P 500 has really been a 1-to-1 ratio. You had to hang on to a 18% drawdown last December, a 8% drawdown in May, and another 8% drawdown in August to end up with a potential 20% return from the December lows. Now that's assuming you're able to buy at the low and ride it all the way to the top. So our portfolio does very well in down moves. You can see in December we returned 1%. May 2.2%, August 0.8%. So if you like to protect your capital, you think maybe the market's a little overbought here, a lot of risk going into the 2020 election, you and I are on the same thought process. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Our goal is income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And we have a special ending Wednesday, Thanksgiving special, 40% off our normal advisory rate. Plus, you'll get 1 month free into our $10,000 boot camp. We're only going to give 5 spots this special deal, and it does end at 5 Eastern, 11/27. So call Dean now to lock in your discount and get a free month of the boot camp. 505-322-7515. Okay, let's take a look at today's trade alert. Got the funny cartoon. Stock market has blown past earnings per share. It's predicting that if we get a trade deal, earnings per share is going to jump by 2 multiples, which is just absolutely ridiculous, especially when we look at the big picture of the global slowdown. So we're really just getting a Fed-manipulated market right now, plus emerging markets continue to slow down, and money is just fleeing out of emerging markets as fast as it can into U.S. products. We're talking U.S. dollars, treasuries, and stocks. So we're enjoying this profitable run-up, but with safety. So you can see we've been able to safely rack up profits on the SPY ETF with an option caller. So that does mean we give up some of the profits, but when it sells off, we give back very little of the profits we've collected. So you can see back on October 28th, I was predicting a 315 SPY from hopes of a trade deal. And we've been able to play that all the way to the piggy bank. You can go to your email, you can look at all the trade alerts and see all the profits we racked up. But now we're getting into that danger zone. And despite China saying we're so close to a trade deal, I really think that is some more trickery by the Chinese part, and that they are going to ramp up the pressure going into the 2020 election. Why give Trump an easy win when they don't have to? They can just wait it out for 12 more months and see who is really in the driver's seat at that time. So we'll see. We're not playing it in one way or another. Our portfolio is actually set up to profit from a big move in either direction. Either stocks crash and bonds fly up, and we're prepared for that with put options below both assets, or we really get this phase one trade deal, and that'll probably put a little pressure on the bond market, and we're going to be doing really well with our emerging markets position and SPY position. So if you do go to your trade alert in your email, feel free to click on any of these links and you can go see all the trades. The good, the bad, the ugly. Our emerging markets position is flat today, although I do suspect it will start to rally a little bit. We had a great month in October, but November has been really sluggish, and this to me indicates that the slowdown in China is worse than they are reporting, and that people are a little more skeptical of a trade deal actually being finalized. TLT is traveling higher. The big picture there is the government's creating too much debt, and if they were not to artificially lower rates and buy up bonds, the yield would spike and the debt would be just too expensive for Americans to service. We're already paying $500 billion a year in interest. That would go much worse very quickly if the bond market really got scared and ran for the exit. GDX is down 27 cents a share, offsetting our gain on the TLT. Although I'm really confident in the long run, gold's going to do very well. We have 60% of all central banks lowering interest rates, printing money. They've been doing this for a better part of a decade. When the money gets out of all these bubbles, it's going to find its way into hard assets, and that's when we're going to really see the benefits of GDX. So we'll take a look at the charts for GDX in a little bit, but I still love that position. We're breaking even so far in November after having to deal with quite a sell-off in the bond market from this phase one trade deal. Had a few bad trades in there, but we've been racking up gains on that and doing very well in the SPY ETF. As you can see, we're now up 1.7% in the SPY trades this month. Our best performing asset class in November is by far the SPY. Emerging markets is up 0.6 today, so it's doing a little better than it was Friday's reporting. Bond portfolio continues to inch up some profits after giving us a little bit of a pain in the portfolio in October and November. But this is one position I have absolute confidence in. And if we go look at the Fed minutes, all they talk about is how are we going to deal with pushing rates to zero, then what? How are we going to not freak out the bond market when they realize they can't cut rates any lower? So that's the biggest discussion going on over at the Fed right now. They're at 1.5 to 1.75 in terms of rates, and I do suspect they will slowly but gradually push that all the way down to zero. And if you do look at their latest Fed minutes, that's all they're talking about. What are we going to do as we get near the effective lower bound? And in our boot camp, we're actually going to be discussing that a little bit in our Q&A today before our next module lesson tomorrow about how to short China's currency. China's big goal is to become a reserve currency like the dollar, the Japanese yen, or the euro dollar. And to do that, they're going to have to allow capital to flow in and out of their economy. But right now, they just trap money in and they really don't let any money out. So that's a big problem for them to reach their goals. So we've already looked at the returns. Let's take a look at the trade alert today. We're buying to close the 312 call and selling to close the 310 put. Now, if you didn't take Friday's trade, you would skip this and go to step 2, where we've sold to open the 314 call, expiring Wednesday, November 27th. And just a heads up, on Wednesday, we'll be writing a covered call that will expire next Monday. And instead of trading The TLT and GDX this Thursday. We'll be trading that this Friday. So a slight alteration to the timing. And then we're buying to open the 312 put. Again, that just means we give up profits after it travels to 314. But if we get some bad news between now and Wednesday, we get a maximum loss after the SPY goes below 312. And that means we get 312 a share for our SPY ETF because we bought the insurance. Here's our risk graph. It's a 1-to-1 risk to reward ratio, so we can either gain $1 or lose $1 on this trade. Let's take a look at the topical news today. Okay, so we got a whole bunch of positive news over the weekend, from China at least. Not so much from the US, which is interesting. Trade war update: contrary to negative media reports, China and the US are very close to a Phase 1 trade deal, and China remains committed to continuing talks for a Phase 2 or even a Phase 3 deal with the US on equal footing, experts close to the Chinese government told Global Times. And good morning, Ron and Tom. Thanks for saying hello in the chat. China and the U.S. have basically reached a broad consensus on a Phase 1 trade deal, including the removal of tariffs, though some differences remain over how much tariffs should be rolled back, experts close to the talks. China's Global Times releasing another trial balloon, saying the deal is done with tariff rollback. Same thing happened 2 weeks ago when Trump had to deny it publicly. China is desperate to shape the narrative as controlling Trump's actions, but jeopardizing the deal in the process. Meanwhile, Newsleak shows operating manual for re-education camps for Chinese Muslims in Xinjiang region. This actually hit the Bloomberg News last night with a very detailed article, which is surprising because we do have Bloomberg's first speech coming out in an hour and 15 minutes, and I've been very curious what his stance on China would be, as he not only had representatives of himself over in the latest meetings in China, mostly big bankers from Goldman Sachs. Their publication put out a very nasty piece about China today, and they've also been criticizing the actions in Hong Kong. So this does strike me as odd, because I know the Bloomberg products, their index ETFs, have put billions of dollars into China. So very curious why exactly they're coming out with all this. Looks like both parties of the aisle are hitting China hard, from the Democrats and the Republicans. So maybe China's finally feeling the pressure. And so we'll see how this turns out. Historic turnout in local council elections in Hong Kong. The result, a landslide vote for freedom, democracy, and continued autonomy from Beijing. The people were heard loud and clear. Now their leaders need to listen. Meanwhile, the Senate and House passed a Hong Kong freedom bill that Trump has been trying to not talk about. He's supposed to sign it or veto it. China's demanding it's vetoed, but the Senate would probably just overturn that with a 2 out of 3 vote. So we'll see if this is really a deal in the works or if this is about to implode on itself. Meanwhile, China is trying to crack down on capital flows. They have trapped trillions of dollars into their economy, wasted it building cities that have gone bankrupt. Their debt to GDP, which they've just linked themselves, is at all-time highs in the 300% ratio. Tomorrow we'll be looking at this in great detail and why it makes sense to short their currency probably for the next 5 to 10 years for massive profits. Timing can be a little difficult, but we'll be going over all those details tomorrow in our Module 2, which just specializes in how to use the Hong Kong Exchange futures market and interactive brokers to gain access to this market and short their currency. If you go back a couple decades, it's already went from 2 to 7.2, a move that is just absolutely mind-blowing, and I suspect it could travel much higher if they do really want to become a reserve currency, which we know they do if they want to bring in capital for their next big construction project, which is the Belton Road Initiative. So they're stuck in a very troublesome place. They're not going to be able to open up their economy when America's applying maximum pressure. So we have seen them cracking down on every little thing possible. You're only allowed to get $15,000 a year of money out of China if you're a local citizen. You're not allowed to do any big deals without permission from the government over $10 million. So they're trying with every way possible to trap every penny they can into that economy. So we've seen a little bit of a sell-off in crypto, but this is not the end of crypto's run. As long as we have rates going lower, we have central banks buying up bonds, which essentially increases the global money supply. You want to be long gold and you want to be long cryptocurrencies. So if you're below a 2% total position in crypto, which is our maximum allocation we recommend, today's a great day to buy the dip, as I do suspect this will be traveling much higher. Meanwhile, ATMs are spitting back bank cards in Lebanon as dollars have virtually disappeared. Part of our presentation tomorrow is actually the global phenomenon of how much money has been lent out in US dollar denominated debts and why almost every major currency in the world has dramatically devalued against the dollar. The only currency that hasn't is the Japanese yen, and they've done this by going into massive, massive debt. So it's not a good picture for future generations in Japan. They have had no growth. Their government owns 60% of their entire stock market. It's a banana republic economy over there. And so we look at the big picture that China wants to become a reserve currency, but they've misallocated trillions of dollars. You think the 2008 housing bubble was bad in U.S.? Wait until you see my boot camp presentation tomorrow. It's much worse in China. There are cities that have just been abandoned that are half built. And we have pictures of it. But that's just their problem. When we look at the world problem, they are desperate to get their hands on dollars. So it's a great trade setup. And this is happening worldwide. The world economy is slowing down. And it's because China is the culprit. They were the big growth engine of the last 3 decades. But their strategy for creating growth is failing. And we can see that with their debt to GDP levels skyrocketing in the last decade, going from 200% GDP debt to over 300%. So they're in a period of trying to work down these debt levels, which is just detrimental to growth and to their currency. So it's causing more people to try to get their money out, and they're clamping down and trying to block every little hole that allows money to flee from China. German business confidence is improving, but this is all from government stimulus. They're not really getting new orders. China's inbound soybean shipments from the U.S. slumped to 1.15 million tons from 1.73. So their main purchase of agriculture was just to feed their hogs, but they lost 80% of their hogs from African swine, probably from pollution. The place is the biggest polluter in the world by far, and so it's no wonder why they're having problems with their food supply. Chinese city commercial banks saw a rare drop in profits, putting the mid and small-sized banks facing funding strains in a more difficult situation. Some more signs of growth slowdown. Bloomberg, secret papers show China's tactics for Xinjiang detention camps. So some internal documents were released, verified, made it all the way to Bloomberg last night, which is pretty careful about what they will publish. And the most shocking thing for me, besides the way these camps work, you basically have constant monitoring. It's ridiculous, but the scariest thing of all of this is that they're using their camera system to track people, identify who they are, and try to predict if they have this bloodline of these Muslim groups that have been known to protest and go against the Chinese party. And so this software that they have will print out One bulletin showed that officials identified more than 40,000 Huawei users for investigation and potential detention. Of those, 32 were listed as belonging to terrorist organizations. They're scared people will spread religion through Huawei. That's an app. So it just searches tons of variables to try to predict who might break the law before it happens. And they're throwing millions of people into these concentration camps. It's absolutely horrific. And I think this could be coming to light in the next few weeks, especially if this trade deal breaks down. We've already seen Mike Pompeo and Pence publicly denounce these actions that Chinese are doing. And we're also seeing the pressure in Hong Kong continue to build. Wang Yi, based on its domestic law, the U.S. has interfered in China's internal affairs and tried to damage our one country, two systems principle and the prosperity and stability of Hong Kong, which violates the UN Charter and the basic norms governing international relations. China's growth is a sure trend, and it will not be stopped by any forces. For the U.S., zero-sum games will take it nowhere, while conducting mutually beneficial cooperation with China is the right way forward. Here's a look at the potential path for China's GDP, and it is in a trajectory much lower. And again, it's not just the absolute print of the GDP that's important, it's the rate of change of their growth. And the rate of change is very fastly accelerating, and that's why we're seeing all these emerging markets and trading partners like Germany in a very tough period of time where they can't pay their debts, they're having to print money, lower interest rates, and it's pushing the dollar, the U.S. treasuries, and the U.S. stock market much higher, even though we're seeing a period of a global slowdown. Now, this is one of the bigger sticking points in the trade deal, IP theft. And China says, don't worry, we'll take care of it ourselves with worse penalties. So I don't think that's going to fly. But the last big headline they did that was supposed to be a big win for the U.S. was outlawing fentanyl. Now they're saying they'll take care of the IP theft. Also, 60 Minutes Australia came out this weekend with a Chinese spy who went to Australia and was telling all the things they were doing for the government, including trying to create propaganda in Hong Kong, going around stirring up violence and trying to change the narrative. So that came out this weekend. China was outraged by that, says he is a convicted fraudster. Eurozone weakness persists, however, in the case of Germany. Few are mentioning the deteriorating quality of GDP as government spending offsets investments and domestic demand. And so you can see the Eurozone GDP continues to have very troubling time staying above that 50 PMI. And now they're all in the rush to print money and try to get out of this slowdown. China's skyscraper boom comes crashing down amid developer defaults. Now in our boot camp, we'll be looking at a whole bunch of cities they've just stopped building, just half built. You could just see these skyscrapers half built, dead in their tracks. We'll also look at the big cities that are booming, but they just took it way too far. They could have used maybe 10 of these cities, which they have 10 Tier 1 and Tier 2 cities that are somewhat vibrant, although from what I hear, those skyscrapers are 25% filled. They're just not able to generate a profit from these cities they're building. So they've abandoned it. Now the new scheme is the Belton Road Initiative. The problem is they don't have any money to do it. And as U.S. clamps down on them and starts to cut them off of the dollar, it's going to be harder and harder for them to keep all these people employed as the big picture gets worse and worse. China media steps up U.S. criticism for Hong Kong meddling. President Xi Jinping calls China's sprawling Belton Road initiative the project of the century, but many challenges remain. Senator Bob Menendez, Congress did its job, Mr. President. We are proudly standing with the people of Hong Kong, freedom and democracy. The question is, will you? The violence in Hong Kong began with Chinese PLA and PAP dressing in civilian clothes and smashing things to give the Hong Kong police cover to brutalize the peaceful protesters. The U.S. will not submit to a communist government that doesn't respect its own people, basic human rights, or the international order. With 85,000 Americans and 200,000 Brits in Hong Kong, this joker of the PLA commander is subtly threatening war. China does have an internet firewall with pros and cons. It's also controversial in China, but in any way, the U.S. criticism exaggerates and distorts China's internet regulation. Firewall has cracks. There are ways to get around it. Chinese people know what's going on in the world. Meanwhile, the banking system is not all right. The Fed repo is continuing to be oversubscribed. The most recent was 2 times oversubscribed. Who's lost the billions of dollars? We don't know. But this does signal there's some underlying problem in the banking system that's causing the big banks not to lend money overnight for what would be thought of as a guaranteed easy profit. They're scared if they lend this money out, it won't be returned. Net leverage on corporate balance sheets resumed its upward trajectory, now approaching the highs reached in the late 1990s. And commodities index hit a all-time low. This is a century low relative to stock prices. And this is what China's been converting its currency into. So there is some conspiracy theories that China's ultimate plan is to convert its CNY from the euro dollar into commodities, which people don't appreciate right now, obviously, due to these super low prices. And then in the Great Global Reset, they will own all the commodities and force people to trade with them in their local currency. And that's how they supposedly will become a reserve currency like Japan, the euro dollar, and the US dollar. Donald Trump pushed hard to have Apple built in the USA. So we are seeing more and more companies get out of China and find other places to build. The boomer bubble. Seniors are expected to vacate roughly 21 million homes over the next 2 decades. That's more than the amount of new properties sold during a previous 2-decade period that ended with the housing boom. So are real estate prices about to have some downward pressure? Perhaps. Which would alleviate a lot of problems with this populist revolution we've been seeing. The biggest problem they have is they just can't afford their rent, and the Fed doesn't calculate rent, college, medical as a big part of the CPI or the CPE, so they keep rates low, which is why we have these protests all around the world. Central banks' strategies have just bubbled up all asset classes and got very little cash down to the working class. Meanwhile, share buybacks continue to drive the stock market higher. As long as rates are low, this phenomenon will not be broken. So we've got the government creating massive debt, which is keeping GDP at least decent, although we're not creating more GDP than we are debt. We've got the president rumbling up the rest of the world so that they become fearful and buy U.S. products, and you continue to get this big bubble up. And the biggest benefactor of this is the wealthy. The 100 richest people approach 3 trillion in estimated wealth. Now that's funny money. I mean, the real value is if you could convert that into dollars, but if they try to sell their stocks, they would obviously crash the stock market. So they're all trapped in funny stock money. On top of this, CLO managers are becoming more defensive. Any CCC assets over 7.5% need to be held at market to brace for further downgrades. This means more triple B selling and paying for triple Cs, as there is no pool of capital waiting with open arms like there is for fallen angels. Eventually, price will work itself out and attract some tourists into the space, but it seems to be the dynamic at play based on my conversation. The long view has been trying to short the market for the last few weeks, although I think he's having a little trouble with that play yet. Bloomberg all in, race of a lifetime, battle of the billionaires. I'm excited to see his first speech coming up in about an hour, see where his hit points are. He already spent $35 million in ads targeting Trump. Trump support for impeachment is dropping like a rock down into the 20s. In some polls, Democrats should not get down to work and finally approve USMCA. Also in the Dallas Cowboys game, he was running anti-impeachment ads. So he is clearly scared that this is going to move forward. And it looks like it will. House Democrats are starting to compress weeks of depositions, documents, and testimony into a report almost certain to result in articles of impeachment against Donald Trump. We're thinking it may hit next week at this point. Elizabeth Warren, federal minimum wage in 2009, $7.25. Federal minimum wage in 2019, $7.25. It's time to raise the wage. Will Elizabeth Warren have a better voice to the Democratic Party than Michael Bloomberg? He spent more money in the first ad buy than I think she's raised to date. So we'll see. Does giving away money free work better? Or does just having billions of dollars to spend on ads work better? And I don't think it's spending money that actually counts. If we do look at the history of spending versus election wins, there's not a really strong correlation. And just look at Hillary Clinton. She spent almost twice as much as Trump and was demolished in the last election. And that's with all of the media being on her side. Who would forget all the media telling us that she had something like a 95% chance of winning the night before? Hunter Biden seems to be out. I think we now have a competition between Elizabeth Warren and Michael Bloomberg. And Bloomberg's clearly got every billionaire, maybe except Trump and maybe some military hawks on his side. And Elizabeth Warren is really reaching out to everybody in the lower class. So we'll see if she can get them out to vote and if she can win the primaries against Bloomberg. It's going to be an interesting race. Nancy Pelosi, Adam Schiff, AOC, and the rest of the Democrats are not getting important legislation done. Hence, the do-nothing Democrats, USMCA, National Defense Authorization Act, gun safety, infrastructure are dead in the water because of the Democrats. Meanwhile, internet is down in Iran and more than 100 protesters have been killed. Polls have now turned strongly against impeachment. Giuliani says he has Biden documents to be released if I disappear. Elizabeth Warren. Mike Bloomberg is placing $34 million in TV ads in 1 week, the most of any presidential candidate in history. That's one way to pay less under my wealth tax, because in a Warren administration, he and his billionaire friends would finally have to pay their fair share. All right, we're at our charts now. We've got the SPY. I think 315 will be about a top before we get something substantial in the trade deal. If we do close a phase one trade deal and they do roll back some tariffs, I think we could travel towards 330. And then we'll start worrying about what the heck is phase two all about. So we'll see. Are the Chinese going to give Trump a win into Christmas, only to disappoint with phase two next year? Hard to say. And also in our boot camp tomorrow, I have the entire history of the tariff war, line by line, chart by chart against their currency. So you can get a feel for how exactly we want to short their currency and win, and what kind of motions back and forth we've seen. One day it's great, one day it's bad, one day they're talking. So it's whipsaw action for sure. TLT has given us a little trouble over the last 2 months, but we can see the rally has begun back. If we do roll back some tariffs, get a phase one deal, there probably will be some downward pressure on the TLT. But on the other hand, if any bad news comes out, we learn what the heck's going on with repo madness, a lot of big pressures that will drive the TLT much higher. I'm not really worried about being long the TLT until we get towards the effective lower bound, which is what the Fed is freaking out about now, is how do we keep bond investors holding these treasuries as we get towards the 0% interest rate, the federal funds rate? What's going to stop them from all fleeing for the exit at once, driving yields extremely high, which in turn would crash the stock market, ruin credit markets? It would be a disaster. So they're inclined to continue slowly lowering the rates, buying up these bonds, and giving everybody the impression everything's okay, but you know what? We're going to have to do another little rate cut here. And think about the last 3 rate cuts. They said that was the last cut, and now we're in a holding phase. Well, then the next opportunity came and they continue to cut rates. So perhaps they will not cut rates in this next meeting, but I don't think they'll be cutting rates at all until we get towards, or rather raising rates until we get to 0 and see inflation perking up. And then they really have no choice. Emerging markets has been rallying for a month. We've done well with that. My target for that is to break past 52 with a phase 1 trade deal. Beyond that, we're above the 2017 highs. And again, this is just manipulated stocks. The big problems with China and all their trading partners is really bad. So we'll be more than happy to use the inverted option collar to short this asset when the time comes. But right now we got to play the news. The news is phase 1 trade deal is inches away. A few short putts. Short strokes, according to Larry Kudlow. Gold prices are elevated. The more money the world prints, the higher a value of gold. It's just that simple. So we have lower rates. We have central banks buying up bonds, monetizing debt, increasing the money supply. Last ingredient is a little fear. If you don't think we're going to have any fear between now and the election, then you shouldn't own gold. But if you do think there will be some volatility, some surprises that catch you off guard, you want to be long gold. And not just spot gold. Gold miners are really the ones who can benefit really well from gold prices above $1,400 an ounce. And meanwhile, we're seeing all the central banks, they're not buying up dollars now. They're trying to solidify their central banks with gold. So they're putting about 15% of their assets into gold if you're in China, Russia, and a lot of these emerging market central banks that have been devaluing their currency. And it's quite remarkable just how devalued most currencies have become around the world. It's at the point where now every dollar they print to try to pay off just interest on U.S. denominated debt is at a ratio of around 1/2 to 1/3 of the value it was just a few years ago. So the cost to service their debts is up anywhere from 2 to 10 times depending on which country you live in right now. So that's unsustainable, and why we continue to see the dollar push higher, even though our central bank continues to be very dovish. LQD is your investment grade bond fund. This means at 129, Microsoft and Apple can borrow for just about free. If they go to Europe, they can get paid to borrow. What do they do with that money? They buy back their own stock. The lower rated debt is HYG, your junk bond ETF. I guess about 7.5% of this fund is the triple C rated bonds, which their rates have skyrocketed to about 13% recently. So we are looking at this as potentially a warning sign for the credit market, although it's still looking relatively strong, not as strong as it was several years ago. But it is starting to show some weakness. This may be the first market to crack. It's that low-grade bond market for small to medium-sized companies, and those rates continue to climb while the rest of the companies in the top are getting lower and lower rates. So this discrepancy is not going to work for much longer. Here's a look at your dollar. To get a feel for how high the dollar could go, just look back to the dot-com bubble and also the 80s. So I suspect this will travel much higher. The big picture is that everybody is desperate for dollars. Their currencies have devalued. They have about $11 trillion in US dollar denominated debt, And their means for paying that debt revolves around printing more of their own currency, converting it into dollars, but the exchange rate continues to go against them at rapid pace. And so when you see how bad it is, you can see why the force for the dollar to bubble up even further is really in the cards right now. And crypto had that sell-off from China cracking down on capital outflows, but never been a better time in history to be long Bitcoin or gold when you get the big picture right here. We just need a little panic. Here's your CNH, that's your offshore Chinese currency. And so if you go back another decade or two, it used to be at a 2 conversion rate. Now it's at 7. So the Chinese offshore yuan is devalued by a factor of about 300% in the last 3 years, or rather 30 years. And they've printed trillions and trillions of this currency and just loaned it to their different parts of their government and then into the corporate sector to build these massive cities. Now their debt to GDP is over 300%. It's unsustainable. They're trying to get all the misallocated capital out of their economy, and they're desperate for investment. Here's a look at the spot gold, having a little sell-off. I'd suspect it could go as low as $1,400 if we get a phase 1 deal, which would be pretty negative for GDX in the short term. That's why I've been paying a premium for my puts on all these assets. We're really at a pivotal time. If we get a phase 1 deal that does roll back tariffs, expect gold and bonds to sell off for a short period of time and for stocks to rally for a short period of time. We do not get a trade deal, we'll get the opposite. So we want to have exposure to benefit from the upside, which means we don't want to sell a covered call that's too close to the strike. But on the other hand, we know one of these assets is probably going to take a big hit in the near future. So we just want to pay a premium for the put options below all 4 assets. That way, whichever outcome hits, we reduce losses on the asset class that pulls back and capture a big gain on the other. So that's how we've been playing our portfolio for the last few months, trying to figure out if we really have a trade deal or not. Crude is in a safe place. If it goes too low, we want to short stocks. If it goes too high, we want to short bonds. And we look at the German 30-year bond. You can see it's in a downward slope. This puppy's headed to negative territory soon. And so that's the overall market of the total bond market. And you can see the correlation with the U.S. But just note how much stronger the U.S. economy is. If we do look at all the debt levels, everything, even though the U.S. has the most debt in the world, the bottom line is we've been better with our economy than anyone else. Our debt to GDP levels are better than everyone else's. Our interest rates are higher than almost everyone else's. And the future prospect for our top companies is much better than everyone else's. Plus our legal structure is better. So there's just a lot of advantages to being in the U.S. right now that really add up. And that's why we've continued to see so much money flow into American products, all-time highs in stocks, treasuries, the dollar's outperforming all currencies this year, and that's against all major currency pairs. All right, guys, that's a wrap for today's update. I do want to remind you we have a 40% off deal for our annual membership that ends Wednesday at 5 Eastern. You can get 1 free month in our boot camp, which is a $10,000 boot camp for free when you join. So call Dean at 505-322-7515. We'll get you signed up. Markets at near all-time highs. If you don't want to give back all the profits you've accumulated, not just this year, but for the last 11 years, join our program. We will protect your capital. We're not going to miss out when the market goes higher. But when stocks go down, this is the product you need to have your portfolio following. So stop playing it like Clint Eastwood. You've already got very lucky this year. Let's lock in those profits and prepare you for what may be around the corner.